Why do rich people borrow the most money? Because you can spend the money just as if you earned it, but you don't pay tax on the borrowed money. Hey folks, welcome back to the channel where we talk about what rich people do with their money and what we can learn from them. When it comes to building wealth, the rich tends to look at investments in a different way than everyone else. Most people are sort of conditioned to buy low and sell high. This makes sense intuitively, but what a lot of high net worth individuals do is they buy low and they borrow. That means instead of selling high, they just hold their investments forever and borrow against their existing assets to pay for their living expenses or to put into new investments. And there's a lot of lifestyle, timing, and tax advantages of doing this. So in today's video, I'm going to explain how this buy low and borrow strategy works and why it's not just for the super wealthy, because the tools are pretty much available for anyone to use. And also some risks that you should be aware of before you consider trying this out. For example, if you borrow too much, you could risk going broke and not be able to afford food or your utilities anymore. That would certainly make for some dark times, which is why it's always important to understand the potential downsides before trying something out. So the first step is to buy some sort of asset, preferably one that either produces an income or is expected to increase in value over time. Common asset classes include stocks, bonds, real estate, farmland, insurance plans, and even small businesses. This can be done either just with cash or a combination of cash and borrowed money. For example, if you buy a house, part of the purchase will be the down payment and the other part will be a mortgage or a loan from a lender. And even though it might be obvious, it's still worth noting that this buy and borrow strategy tends to work a lot better if you're buying high quality assets and not just anything that somebody else is willing to sell. So it's probably a good idea to form a basket of different assets, like a diversified portfolio, because the resiliency of your overall assets will determine how well the next step is going to go for you, which is borrow. So after you purchase your assets, it's time to borrow money against those assets. And these types of loans will be secured because they're secured by tangible investments that can act as collateral. This type of debt is different from an unsecured loan, such as credit card, which is very high risk because if you don't pay back the loan, the person who lent you the money can't really get their money back by selling an appropriate asset. So for example, if you had $1 million invested with Merrill Lynch, you can take out a loan, let's say $500,000, and pay an interest of 3.2%. Then you can use this loan to invest in other assets. As long as your annual return is higher than the 2.3% cost to borrow the money, then over time you're going to end up financially ahead. In a lot of cases, you can use the money however you like. Maybe you'll spend $10,000 of it on a new roof and spend another $10,000 maybe on a fancy vacation with your family. That's still going to leave you with $480,000 that you can invest. Even if you don't get crazy returns and just buy a diversified, balanced portfolio of 80% stocks, 20% bonds, you're still likely going to see over 6% annualized returns over the long run, which is way higher than the 3.2% with the current interest rate environment, although rates are going up. So how common is this buy and borrow strategy? Well, taking one example, the balance of secured loans at Morgan Stanley has doubled since 2016. So besides just the numbers making sense, here are some other advantages of buying and then borrowing instead of selling. First of all, you save a lot of taxes using this strategy. When people buy low and sell high, which is what a lot of people think you should do, you're going to pay capital gains tax when you sell your investment. But when you borrow against your assets and you take out a loan, you don't pay any taxes on that. In fact, if you're using the loan money to then invest in something else that will produce an income or capital appreciation, then you can actually write off the interest or the cost of that loan. So that's one benefit of buy and borrow. Here's Robert Kiyosaki in an interview where he explains how he takes advantage of borrowed money.
So when they lend out, why is debt tax-free?
I don't know.
Because that's how money is created. And so the banks love it. They love people who borrow lots of money. So how do I get rich? I borrow money and I buy assets with it. The poor person borrows money and buys liabilities like purses, and they get poorer and poorer and poorer. But I use debt. I borrowed $300 million after the crash to buy real estate that made me rich.
The other advantage is the income that you earn from investments that are bought with borrowed money are usually taxed more favorably than earned income from a job, let's say. Which is why, as people progress through their careers, it's a good idea to plan for how you're going to make more passive income and more investment income as you get older rather than through just earned income, because eventually everyone retires, and having a tax strategy in mind sooner is better than later. And speaking of retirement, one of the biggest risks facing people who are getting ready to retire is sequence of returns risk, or sometimes called the last decade risk, where if the stock market or their portfolio drops substantially in the last 10 years of their working lives, then they may be forced to live on a lower income in retirement than originally planned because their portfolio has shrunk by so much. However, this buy and borrow strategy solves this problem, because instead of shaving off bits and pieces of their portfolio when the financial markets are at a low point, retirees can simply borrow money against their current portfolio and live on this borrowed money like they originally planned, and then just wait for the financial markets to go back up. The more compressed PE ratios are and the lower the stock market is, chances are the higher the returns are going to be in the future. So you don't want to miss out on that future growth. By selling your stocks, you're giving up ownership of the company, so you're not going to participate in any future profits. And speaking of company stocks, a lot of startup founders do this. They monetize their stakes and get liquidity without losing control of their companies. And this is why millionaires and billionaires think about debt in a different way than ordinary people. For example, Fred Smith, the chairman and CEO of FedEx, pledged almost $600 million worth of company stock to get loans, and then he used those loans for outside business ventures and also to purchase more FedEx stocks, which is basically like buying stocks on margin. A lot of life insurance policies have a cash value component in them. This allows you to take out policy loans against this cash value and use it to supplement your income in retirement. According to Forbes, with some universal life insurance, you can withdraw this money as a loan. And as you might have guessed, you can borrow tax-free from the cash value component of your policy. If you die before the loan and interest are repaid, the outstanding balance will just be subtracted from your death benefit. So in a way, you're kind of sharing the total death benefit with your beneficiaries. So you're getting some and then they're getting some. And it's all very tax friendly. Now, is there an appropriate time to actually sell instead of just holding forever and borrowing? You can certainly sell in some cases, but what often happens is rich people just hold on to all of their assets until they die. So this strategy is sometimes known as buy, borrow, die, because that's exactly what happens. So as the person's assets increase, their liabilities or debt also increases. And by the end of life, hopefully the assets are much higher than the liabilities, so they can pay off all of their debts and still have money left over to give to charities or their kids or whatever else they want. For the most wealthiest out there, they do have access to very low interest rates, which is definitely an advantage. However, the good news is even ordinary people like you and I have access to this tool with slightly higher interest rates, but I think it's still very reasonable at this time. So here are some practical ways that I've used this buy and borrow method in the past. One instance is I bought a property a long time ago. I waited for that property to go up in value, and instead of selling it when I moved out eventually, I borrowed money against it in the form of a home equity line of credit, which is like a revolving credit line with a low interest rate that I can tap into at any time. And then I use this money to then go buy another property as an investment. So my original property, I rented out, and it's a cash flow positive property for me. So I don't have to worry about putting more money into it every month to manage the property. The loan to value ratio of my second investment property now is about 70%. I'm going to wait until the asset appreciates in value, and I'm going to take out another HELOC from this property and then use that money to go invest in the stock market or something else. And this way, I always maintain my asset column, and that's just going to grow over time. And because I believe I have really high quality investment properties in a growing city with lots of immigration coming in, maybe sometimes the renters won't pay or there will be like a major repair, but I think over the long run, the fundamental value of these properties, along with the income that they generate, will grow at a faster pace than the cost. So another personal example I can give is I put money into my brokerage account with IB, and at this time I can borrow up to 70% of the stocks that I have in there. Meaning, if I put in like $100,000 and I buy stocks with it, I can actually buy up to about $250,000 worth of stocks. I currently have a leverage ratio of 1.8, which is pretty high. I'm trying to get this down, but it just goes to show that I can borrow money. And right now I'm borrowing at 2.33%, which is still quite low, despite the interest rate hikes earlier this year. The expected rate of return on some of the companies I'm buying right now, such as Google and BlackRock and other high quality stocks, are double digits annual growth over the next couple of years. So, because I'm borrowing at such a low rate, I think that is a fantastic risk to reward opportunity here. Now, that doesn't mean I think we're at a bottom or anything. In fact, this upcoming week, I expect the stock market to continue to sell off. But I am keeping an eye on things because valuations are much better now than a year ago. So if I need to spend a lot of money to fix like a leaky roof or pay for some unexpected expensive medical bill, I just plan to borrow money from margin and use that instead of selling any of my stocks. Because if I sell those stocks, I won't have them anymore and I'll miss out on all the gains when we have the next bull market. Now, because most of my stocks are dividend paying stocks, which tends to grow their dividends as well, like a lot of bank companies and utilities, pipeline companies, this reoccurring dividend income for my portfolio is more than enough to pay off the monthly interest that I'm accumulating in the account. So this is how I'm managing my margin debt and making sure I'm not borrowing too much. Those are just a couple of examples, but you can see how this works. As long as my assets grow long term faster than my liabilities, then I'm just going to continue doing this. And you can use pretty much anything as collateral as long as someone's willing to use it as collateral to give you a loan on it. So if you have a collection of cars, for example, you can get a secured loan with that. So with the real cost of borrowing still negative, which means debt is super cheap right now, and with all of the tax advantages, why isn't everyone doing this, right? Because the tools are available to pretty much anyone. Like if you can open up a brokerage account and understand how margin works, then that's one way you can use the buy borrow method. Well, unfortunately, this isn't for everyone. First of all, there are some risks to this. If you borrow too much and the asset that you have drops in price dramatically, you could go bankrupt. For example, if you own your house and you take out a loan, so your total loan to value of your mortgage plus the extra loan is like 80%, and then you go buy another property with it. What if interest rates go up like 3 or 4%, and when it comes to renew, you can't afford the mortgage payments anymore, so you have to sell? Well, if real estate prices at this time is like 30 or 40% below the price that you paid, then your equity is wiped out. So you're going to owe more money than the cash you currently have. Your net worth is going to be negative, basically. Same thing if you have a fairly high loan to value ratio for buying stocks on margin, and when the stock market crashes, you might be forced to liquidate. And at that time, you can't sell what you want to sell. You have to sell what you can sell, which is not a very good position to be in. So that's one of the risks with using leverage is you can definitely bite off more than you can chew. And leverage is a double-edged sword. The other thing is you really have to understand what it is that you're going to use the money for when you borrow it. If you don't think you can find a long-term investment that you can get a higher rate of return than the borrowing cost, then it's probably not worth it to borrow the money. So if real interest rates were positive today, let's say the inflation rate was 2% and you can borrow money at 8%, is it worth it to borrow money at that time to then go and invest in the financial markets? Probably not, but maybe. I think it depends on like what the current valuations are, what the CAPE ratio is doing. But it's going to be harder because you have to make a 6% return adjusted for inflation just to break even. So there's a time and place for everything. And depending on your financial knowledge, you might think this is a good idea to buy and borrow. But otherwise, for a lot of people, they're just happy to just buy and continue buying dollar cost average. But it's still a good idea to hold your investments for as long as possible. If you do want to try out this buy, borrow, die strategy, I would start with a fairly conservative loan to value ratio. So maybe if you have $100 worth of stocks, maybe consider borrowing up to $20. That way, you're not taking a very high risk of getting margin called. Let me know if you've used this strategy before. I certainly like using it. In the recent market correction, I've been buying stocks and I've been using my margin to do it, but at the same time, just making sure I'm not overly leveraged. Now, in terms of which kind of stocks I'm buying, it's mostly all GARP. If you're not sure what that is, I explain all of it in this video here in detail, and I also give examples of stocks that I'm actually buying. So feel free to take a look if you haven't yet, and I'll talk to you in the next one.